Wall Street had its worst day since August, despite a flawless market open for Twitter. Economic concerns let some of the air out of a market near record highs. The U.S. economy grew in the third quarter at its fastest pace in a year, but consumer spending was anemic, and the inventory building that pushed the number higher will likely subtract from this quarter's growth. A stronger dollar may also be a drag after a surprise rate cut from the European Central Bank put pressure on the euro. Blue chips down triple digits for the first time since mid-October. The S&P 500 down over 1%, while the Nasdaq saw losses approaching 2%. The microblogging phenomenon known as Twitter is now a Wall Street phenomenon. The stock nearly doubling in its first day of trade. That debut surge gives Twitter a market value of more than $24 billion. That's more than lifestyle brand Michael Kors, more than internet media company Netflix, and 4 times the market value of the parent of the Nasdaq. Comparisons are leading some to question whether social media stocks are overpriced like the tech bubble of the late 1990s. But Topeka Capital Markets' Victor Anthony says no.
The scenario is different now. So you have the companies are a lot more profitable. They generate tons of free cash flow. I mean, Twitter is an exception, but I think they'll generate profits in 2015 and 2016 on a free cash flow basis as well. So the scenario is vastly different now. You have vastly sound business models that exist today, and that's in a sharp contrast to what you saw in 1999.
He has an outperform rating on Twitter, but Pivot Research says the stock is already too hot and slapped a sell rating on day one. Taking a look at how social media stocks fared, Facebook, LinkedIn, Yelp, Angie's List, and Zynga were all down sharply for the day. In other corporate updates, Disney beat earnings forecasts after the close, and revenues were ahead of expectations as well. Meanwhile, JCPenney posted its first sales gain at stores open more than a year since the year 2011. That was good enough for a roughly 5.6% jump in the stock. In Europe, stocks were caught off guard by that rate cut, but Germany bounced back by the end of the session.